longer-term look at crypto, though, let's bring in Michael Saylor, Microstrategy CEO, who, of course, has been a longtime proponent of the cryptocurrency, holds it on the company's balance sheet, et cetera. Michael, it's good to see you. So let's talk about the recent action. And I'm also, of course, it caught my attention, the comments from FTX's Sam Bankman-Fried in the FT over the weekend, where he talked about that Bitcoin is not really going to be a viable transaction mechanism, even if it can still be a good store of value. Does it need to be a good transaction currency in order to reach some of the heights that folks such as yourself have talked about?
I think Sam left off mention of the Lightning Network. It's pretty clear that Bitcoin's the future of money and Lightning is the future of payments. And if you're going to do payments and transactions high speed, you're going to need a base layer that's ethically sound, economically sound, and technically sound, and that's what Bitcoin is. But then billions and billions of transactions are going to go on a layer 2 like Lightning, which is an open, permissionless, ethical protocol. Or they're going to move on layer 3s like Cash App or PayPal or Apple Pay or Visa or MasterCard. Those are securities. They're companies that are custodians that are moving payments back and forth. So I don't know why Sam left that off, but it's pretty obvious to every Bitcoiner that payments are going to take place on layer 2s and layer 3s.
And so for the holdings, though, at this point that you've been able to amass over the years, one huge thing that sticks out is in terms of the crypto winter that we're in right now versus the one prior is the number of larger companies that have holdings such as yours. Is there a certain price target at which you would have to start liquidating some of those holdings?
No, we're in it for the long term. Our strategy is to buy Bitcoin and hold the Bitcoin. So there's no price target. I mean, I expect we'll be buying Bitcoin at the local top forever, and I expect Bitcoin's going to go into the millions. So we're very patient. We think it's the future of money.
So you don't sound like you have wavered whatsoever, Michael, as we have seen this downturn in price. Of course, we've seen downturns in price before. Is this one different at all? Is there any doubt in your mind when you watch the action that we've seen over the past few weeks?
I think that the entire crypto crash has made a couple of things clear. First of all, there's one perfect thing, that's Bitcoin. That's a decentralized, ethically sound, technically sound, economically sound money. There's a bunch of imperfect things. There's the stable coin, the USD, Circle, and Tethers, and BUSD, and et cetera. Everybody wants a stable US dollar. They're struggling with how to do it in a compliant fashion with transparency. Then there's a lot of dangerous things. There's 19,000 dangerous things. It's basically all the unregistered security crypto networks running on proof of stake that have active management, project management teams, that have ICOs, that have some centralization in them. And Luna and UST was an example of one of those crypto security tokens that was mismanaged, and it blew up. And what's going to happen is an entire generation of crypto people are going to get educated on why Bitcoin is the superior asset. And then a bunch of regulators are going to accelerate their regulation of stable coins and accelerate their regulation of the crypto security tokens. And the winner of that entire exercise is Bitcoin, because once people figure out why Bitcoin is superior to everything else, then the institutions are going to come in with large sums of money. And we're not going to have to struggle through this mess of explaining why we're different than 19,000 other crypto tokens.
And just quickly, Michael, just to be clear here, you traditionally have been sort of a Bitcoin maximalist, so to speak. So to be clear, you weren't invested in things like Terra or Luna. Are you in any of the stable coins?
Well, first of all, I'm not even sure. Luna is not a stable coin, but we wouldn't invest in an unregistered security. So 99.9% of everything in the crypto space is an unregistered security. And I might invest in a registered security one day. I mean, if you ask me would I buy Apple stock or Google stock after reading the 10K and 10Q disclosures, maybe, maybe not, but that's not our strategy, right? But I really don't think that any public company or public investor can invest in an unregistered security. That's venture capitalists. So no, we're not invested in it. It's pretty obvious that they're all unregistered securities. And And I think the crypto industry hasn't really addressed that issue. That's the elephant in the room. And the Luna Terra meltdown has actually brought this to the forefront. And now I don't think people can ignore it.
Michael, there's been some stories recently. I think Fortune ran with this one. If Bitcoin falls below 21,000, there might be some form of margin call over at your company. What does that mean? Help us understand, like, what does happen if crypto continues to fall?
That's all FUD. Look, we started with $5 billion of unpledged collateral. We borrowed $200 million against it. So that's a loan to value of 4%. If Bitcoin fell 95% from that number, then we'd have to post additional collateral. People got their hands around the fact that we would adjust some collateral if Bitcoin ever got to 21,000, but it's really a non-issue whatsoever. You can think of it as like leverage of 1.04. If I was levered 10 to 1, we would have borrowed $50 billion against that collateral, but we borrowed $200 million. It's really it's a nothing issue.
What type of regulation do you expect to come over the course of this year, as we've increasingly heard Bitcoin and broader digital assets discussed acceleratingly in Washington, and how does that impact where you would add on to your existing crypto positions?
Okay, well, first of all, we won't add on to crypto positions. We will add on to our Bitcoin position whenever we come into excess cash. And that's a very simple strategy. With regard to regulation, there's been a deadlock in DC and on Capitol Hill around stablecoin regulation and around security token regulation. I think the administration wanted to move faster. Congress was moving slower. I think that this meltdown of Luna, UST, that's going to accelerate the regulation of stablecoins and security tokens, which will be a good thing for the industry.
And Michael, finally, getting back to price for just a second here, do you think that Bitcoin will remain sort of in the doldrums as long as the Fed is in a rate-raising cycle?
No, I mean, I think that clearly Bitcoin's been drawn down with all the risk assets in this deleveraging tightening cycle. But there are also the crypto crash issues and the Luna Terra impact. So over time, I think as people get educated and as they get more comfortable, I think we'll recover from this drawdown. Fed policy is very difficult to opine on or to predict. And so clearly they have a huge impact on how people value all assets, depending upon what they say from day to day.
Michael, we certainly do appreciate the time here discussing not just your own holdings, but the broader landscape as well. Microstrategy CEO Michael Saylor, thanks for the time.
The New York Stock Exchange celebrating a milestone, and Brian Sozzi is there on the floor with NYSE President Lynn Martin. Brian.
Hey, thanks so much, Shauna. Lynn, great to see you again. 230 years. I almost can't believe it. Talk to us a little bit how you have put your stamp on the NYSE since you took over.
Yeah, I mean, 230 years. I know we don't look a day over 229.
No.
I'm thrilled to be talking to you on a day like today where we celebrate, really our evolution. When you think about our institution celebrating its 230th anniversary today, it has withstood multiple pandemics, wars, volatility, which couldn't be more timely than now. So we're super proud of the way we've evolved the institution, really driven by technology-led innovation. And if I think about the last 5 months that I've been in the seat, one of the things I very much focus on is technology and the power of technology, and really continuing to further how companies use technology to innovate, to tell their stories, just like we have for the last 230 years.
Technology, very important. That reflects your background too,
It
as well.
sure
But
does.
how important is it still to have people on the floor, especially when the pandemic was raging in 2020? It was important to actually have humans in the mix.
Yeah, I mean, the role of the humans on the floor has never been more relevant than now when we're seeing these increased volatility, especially intraday. And the data we're looking at, the NYSE listed stocks are trading with 2 times less volatility at the open, 3 times less volatility at the close. And that message has never resonated more with our issuer community, particularly in times like this. So the role of the human to really smooth out the anomalies during volatile situations has never been more relevant to our existing issuers and importantly to those issuers who are still looking at coming to market.
Talk to us a little bit about the average person out there. It has been a tough, I would say, 3 months for the markets, especially the past month. What is going on here?
Yeah, it's been a challenging period for the markets, driven by a variety of factors. You have the geopolitical uncertainty. Our hearts continue to be with the people of the Ukraine as they continue to deal with the challenges that they're facing against Russia. But there's also, uncertainty about the U.S. economy, inflation in particular. That's very much on the minds of the investor, dealing with inflation, dealing with price of gas, price of food, whatever the case may be. And you're seeing it also at times around the interest rate hikes. So the Fed cycle, is the Fed going to continue to raise rates 25 bips in March, 50 bips more recently? What does that outlook look like to really curb inflation? So you kind of have two different dynamics at play at the moment. And that's weighing on investors, understandably. But the most important thing is our markets are continuing to operate as they should. Open, transparent, and efficient. Our markets have withstood multiple bouts of volatility through our history. And every time there is a bout of volatility, our markets get stronger. Our rules get more refined. Our systems get more refined to be able to handle these periods of stress in a way that buyers can meet sellers, sellers can meet buyers in a very efficient fashion.
This volatility has hurt the number of deals coming to market. It was a challenging first quarter. What does the rest of the year look like?
Yeah, it's not that different from other periods where there's been uncertainty in the market. The deal flow coming to market has slowed, mainly because of the volatility in the market, but the demand is still there. We are talking to new innovative companies every day about how they're coming to market, when they come to market. And they're excited about coming to market, but they're going to pick the right time to come to market. Now, some sectors, we are seeing deals come to market. We had an IPO a couple weeks ago for an energy company, a clean energy company, Accelerate Energy, which performed incredibly well and still trading around its IPO price, which is extraordinary when you consider all the volatility in the market. So for some sectors, I think you'll see them come out a bit sooner than others. But others are continuing to look at volatility metrics.
You and I are getting ready to head to the World Economic Forum in Davos. Different planes, leaving at different times, of course. But what is the one message you are going to take from public markets here in the U.S. to overseas leaders?
Yeah, our markets continue to be the envy of the world. And I don't want the political leaders to lose sight of the fact that the U.S. capital markets are the home of investment. They're the envy of the world for a reason. They have withstood multiple pandemics, multiple wars, multiple periods of volatility. And I don't want global leaders to take our position in the U.S. for granted.
And ESG, that will also be a key message, right?
100%. That's an area we've spent a ton of time on, incredibly focused on, continuing to provide tools to our issuer community, as well as those risk managers who are looking to either disclose their ESG footprint to the market or manage risks associated with environmental, social, and governance metrics.
Meanwhile, a tale of two retail stocks as Walmart suffered their worst day since the '87 crash after awful earnings, while Home Depot bounced after an earnings beat. We're joined now to talk about this with former Home Depot CEO Bob Nardelli, also the former chief executive of Chrysler. It's great to see you, Bob. So what do you make of this? What's your big picture takeaway? Same day we see the Walmart woes, we see a Home Depot makeover.
Yeah. Well, David, thanks for having me on today. Craig Menear and that whole team did an amazing job, not only a fourth quarter, but certainly for the full year, up 14%. If you just look at the tail of the tape, square footage was up, average ticket was up. The only thing that was in the wrong direction was customer transactions, and that tells you a little bit about what's going on there. Transactions may be down, David, but then if you look a little bit deeper, you'll say, okay, it must be price, it must be margin, and it can't be all volume. So I think what we're seeing here in a little bit is that inflation is having a positive impact on the top line and allowing for the margin because of a richer mix to fall through for Home Depot. But Craig's has done a magnificent job. The company's in great shape to hand it over to Ted Decker in June. And this will be, the third CEO since I left Home Depot, David.
Well, Bob, it's interesting because inflation, when it comes to inflation, we heard it from Home Depot, obviously, Walmart this morning in their earnings call. We've heard it from virtually almost every single earnings report that we have gotten in the most recent quarter. From your perspective, though, what's the playbook for CEOs? How do they navigate their company and the future here when we're seeing inflation sky high?
Well, let me say that I'm still very active involved. I'm on a couple of public boards, and I got about a dozen private companies in my family office, and we're dealing with inflation every day. It's not a quarterly thing. It's not a monthly thing. It's every day. And what's happening is we used to, when we get a price increase from a supplier, we might sit on it for a while, see if it's going to hold, and then pass it on. Right now, unfortunately, what we have to do is the minute we get it, we have to pass it on. We're also using fuel surcharges because of fuel going up. We saw diesel's $5.55, $5.56. So we're having to pass that on. So inflation is inseparably linked to the supply chain. You know, I look at a global view of the container ships around the world, and we have well over 550 ships right now floating on the water waiting to get unloaded. We have an equal number of tankers floating on the water ready to get unloaded. So supply chain has caught every company off guard here. And I just don't see it getting better. I know some of your prior guests have indicated a more positive view. I think we're in for a long, rough patch, certainly through the balance of this year, until we get stability back in the supply chain. If you think about the city they shut down in China, you got 26 million people, fourth largest port in the world, and we're not moving product in to get manufactured, and we're not moving product out on the supply chain. So we've got a real challenge here globally in our economy for business. And I've never seen the challenges for a CEO greater than they are today. The broad range of constituents that they have to try and satisfy is unbelievable today.
Well, Bob, that's interesting what you're saying, because I feel like in the last couple of days or several weeks, we've heard many people be a little bit more optimistic about the picture. But you're sounding a pretty concerning alarm here. I guess how much worse could it potentially get?
Well, I think, 1 month of reduction in inflation, I don't think is enough to justify say that it's going away. I think we're going to see. I know the Fed's going to work on it. I know Secretary Yellen's going to work on it, but they're not going to be able to overcome some of the issues that we have out there. We've got some of our biggest customers reducing sales, their forecasts on us by 80% reduction, because they were in this boom period. They overbuilt, for example, distribution centers, and now they're going to have to pull back. And then it rolls downhill. It reduced us by 80. And then the people that we were buying from gets reduced. So I think we're in for a little bit of a rough patch. I don't know if it's going to go to 10% inflation, but I don't think we're through. I know some of your guests thought we had kind of topped out. I think it's going to be with us. I spent last Sunday on the phone trying to expedite chips. If you think about it, in Georgia, for example, auto industry, the auto dealers are down 60% in their inventory, 60%. And so that's not going to fix itself real quick. It just isn't.
And as people have these conversations, obviously around the kitchen table, about having to make some of these tough choices about what they're willing to spend on and what they're not, it was interesting to see that Walmart shoppers weren't as willing to spend. But when it came to Home Depot, executives said they haven't seen shoppers trading down in the face of higher prices and don't expect them to start either. What is it about the staying power that comes with perhaps home building or perhaps home renovation when we do have obviously very expensive housing right now? Is that what's really helping Home Depot float here?
Well, Home Depot is in a sweet spot of any economic cycle. When I was there, you're either going to have people that are aggressively remodeling, or you're going to have people doing a lot more maintenance work. If you look at the housing inventory right now, so people are probably going to say, well, I'm kind of have to stay put, so I've got to do what I've called delayed maintenance. So they're going to be spending on maintenance. If prior to this period, they were doing remodeling because they were getting their home ready to sell, and they were trying to improve curb appeal. So with inventory down, inventory homes are down, I think you're going to see a lot of people working on the maintenance side of this and doing the maintenance work that they've deferred. So Home Depot is in an excellent spot right now. And it was one of the things that I enjoyed when I was there. And I think we'll see this continue. They do a marvelous job of customer service. They've got very strong products. They've got Home Depot supply that takes care of construction in the service industry. So they've got really a very strong hand to play into the marketplace today.
Bob, you referenced the many challenges of being a CEO today, and they extend well outside the walls. If you were a CEO today, how would you handle this environment in which you see Bob Chapek, the Disney CEO, want to stay out of the political fray, but he wanted to satisfy the rank and file, the thousands of unhappy employees that wanted him to weigh in on the supposed don't say gay legislation down in Florida? Ron DeSantis has been punishing him since he spoke out and now wants to put them on the hook for the $1 billion in debt bond and take away their special exemption. And now you've got the issue of abortion across the country. When do CEOs speak out and please their many employees? And when do they stay quiet? There's a new populist, almost anti-business Republican party today. How would you handle it?
Well, the good news is I'm not sitting in that chair today, David. But it's here's kind of been my philosophy: is all of us have a personal opinion. All of us have a personal opinion. If I was to share that, it might be accepted by a certain group, and it may not be accepted by another group. I've always had, the belief in running a company that you have to have market focus. You got to be laser focused on the customer, the clientele. You got to make sure that you are able to attract, motivate, and retain a high-performance workforce. And you've got to make sure that your investors understand what you're doing in that company, both short and long term. What kind of return are you giving them? Is it growth or value? Or in the case of Home Depot, it's both. Home Depot is able to deliver growth and value. And so I've tried not to get involved in that. If you think about, again, Home Depot, you got 500,000 associates. At any given time, do you really want to upset 250,000 associates? And again, if you do about 2 billion transactions a year, you're invariably going to offend one group or another. So I've always believed, stick to the business, do the best thing you can for customers, your associates, your employees, your investors, your suppliers, and stay the course. Stay out of the fray because you're going to upset one group or another.
And speaking of upsetting groups, obviously we see Bezos and Musk weighing in very publicly with their opinions. We saw Jeff Bezos weighing in on President Biden, Musk obviously having a very public conversation about his deal with Twitter. What is your opinion on using that very public forum for some of these business decisions?
Yeah. Well, when you're a billionaire, I guess you have the privilege of doing that. But again, Jeff, owns the Washington Post, so I don't know if he was coming through the paper on some of that. Elon Musk, who's just a brilliant individual, has been known to make comments like that. And I guess they're in a position where they're not going to get the same repercussion that, for example, Disney is getting right now. Unfortunately, it's very sad because that's a great company and it is the happiest place on earth when you get to visit there. So they're in a rough patch right now. I just I don't have any criticism of Jeff or Elon for doing that. It's just not something I would do. And at one point they, to be honest, they came out against Craig and said, he didn't say anything, so let's boycott Home Depot. And I said, well, we ought to have, instead of a boycott, we have a boycott, because you got 500,000 associates. Why do you want to punish the men and women that work hard every day because a CEO, he or she, didn't say something or did say something? So I'd like to get back to the basics of running a company and doing what is fiduciary responsible for running that company. That's my opinion. And again, that may upset some people out there, but that's the way I feel about it.
Bob, we want to get your take before we let you go. We want to get your take on exactly what Jeff Bezos was saying to President Biden and the White House's response to Jeff Bezos, because in his tweet, or in the president's tweet, he linked the fact that higher corporate taxes could help address inflation. And Jeff Bezos simply responded saying that is not true. You should not link those two things together. And in fact, it's misinformation. From your perspective, do you think raising corporate taxes will help address inflation at all?
Well, we've been there. I've lived through that cycle where corporate taxes were raised. And what that caused was an offshoring of a lot of manufacturing. Because I know personally myself, I never had an outsourcing strategy, but I had to have a global competitive strategy. So for me to compete with ABB or Siemens or Toshiba. I had to find the highest quality, lowest cost to be able to put these products together. So I do agree with Jeff from the standpoint that higher taxes are not going to help inflation. What will help inflation is reverse the policies that were instituted on Inauguration Day. Let's get back to pumping oil as opposed to buying oil. We were energy independent. I'm a zealot on energy independence, not only for low cost, but geopolitical positions, opportunities to help Germany, for example, now. The other thing that would help inflation is let's get something done in the ports. The National Guard or the Corps of Engineers know how to drive trucks. They know how to unload containers. If we were serious about helping supply chain and reducing inflation, we would activate and get some things going. So I just don't think we're aggressive enough at trying to solve the fundamental problems of running a business and getting inflation under control and being able to, it's not a demand problem. People aren't going out saying, well, I'm going to drive more because gas is now $4.50 a gallon. It's the supply side that's hurting us with inflation. And I don't see anything being done positively to be able to do that. Your prior guest talked about the 15% ethanol. He's exactly right. That's not designed to burn in today's combustion engines.
We'll let Rick Newman know that you, in fact, agree with him. Bob Nardelli, great to have you on this show. Great to get your perspective. Former Chrysler CEO, also the former CEO of Home Depot. We hope to have you back soon.
Like a broken record, the price of gas is breaking records. Today, the average price of a gallon of gas up to $4.59, according to AAA. All 50 states now averaging more than $4 for the first time ever. So how high can we go, and what is the impact on the economy as a whole? Bob Iaccino is the co-founder of Path Trading Partners. He joins us now. Good to see you, Bob. Everyone's feeling this pain, in particular in California, where it's north of $6 a gallon on average. Nationwide, how high do you expect prices to go?
Well, if you're looking at a nationwide average, I would be shooting for about $5.50. JP Morgan talked about $6, but I can't see there being any sort of political will to let it get that high without some sort of interventionist policies. Honestly, you're not even talking about political parties here. Either side going into midterms would do something about $6 gasoline or to prevent $6 gasoline. There's only so much they can do, so it'll be somewhat synthetic. But we are looking at an increasing demand curve relative to supply. We continue to see Russian barrels of oil come off the market, which of course is pressuring gasoline prices, diesel prices, truckers, the owner-operators specifically of in little small trucking companies really suffering through this along with the general consumer. So I think when you look at it from a price action perspective, we've actually seen crude oil's range compress. But this is what crude oil does, and RBOB does the same thing. It moves sideways, which is actually what's going on. If you look back to March, April, you saw about a 21% range in price, but it was still sideways movement overall. Now we're seeing about a 15 or a 16% range in price. And as we get down to a 7 or 11% range in price, you'll likely see a breakout, and that breakout is more likely to be up than down.
We haven't seen much, if any, demand destruction. At what price point will we?
Well, it's interesting. There was some research done about 6 years ago that said $4 a gallon of gasoline was where you would see consumer demand destruction, but it had to be a prolonged period of time. I don't know what prolonged means. I'm not sure what we're looking at. If this feels prolonged, I mean, two tank fill-ups at $4.48 as it is down here in Florida seems prolonged to me. But we are starting to see some small change in behavior, but it's difficult to measure because we're in the beginning of the summer driving season, not the end. And coming out of the cabin fever of the pandemic, it's difficult to sort of classify this as typical behavior. So I'm not sure that research really applies. We're starting to see a little bit of weakness in airline ticket purchases as prices have doubled in some cases, up 40% on average over the US. I think automobiles are next, but it's very difficult to gauge coming out of the pandemic.
Indeed. And circling back to crude, Jeff Curry, Goldman's head of commodities, said earlier this week $150 oil is a high probability event. Do you agree with that?
I agree with new highs. It's difficult for me to put a price target on that. Our target prior to this move was $94, and we were long crude from the low 70s. When it got to about 94, again, we entered into one of these sideways price consolidations. For us to actually get a price target, we have to break out, and then we have to measure the range that we broke out of. Currently, if we're looking at that sort of 16% range, if we break out of this sort of sideways price action that we're seeing right now, we'd be expecting about $138, about $138. But I can't really put that as a target until the breakout actually happens, because it's going to be more price action based than fundamentally based.
You mentioned diesel. Target CEO Brian Cornell saying yesterday we did not anticipate transportation and freight costs would soar the way they have. Target, as you know, had its worst day since the '87 crash. How do you characterize the overall impact on the economy, on the retail sector in particular?
You know, it's interesting you mentioned that. One of the things I was wondering the other day, as I saw Walmart's earnings, you remember recently Walmart raised the base level that they were paying for their truckers to well above $90,000 a year. You combine that with the increased fuel costs, and you see this margin compression in Walmart that allowed Walmart, I shouldn't say allowed them, I should say more like reckoned them to have their worst single day in the stock in decades, simply because that compression in a discounter like Walmart really hurts. So it's a case-by-case basis, but it certainly is a tax on consumers, and people don't realize what a tax it can be on the types of corporation like a Walmart, like a Target, that isn't necessarily famous for passing those cost increase along, especially in a consumer inflationary environment like the one we're in right now. So I think it's a very big deal, and I think it means we're likely to see more repricing of equities to the downside after a little bit of stabilization. This is the kind of thing that you see in the equity markets where we're now waiting for more bad news. And as it's not happening, you may get a little bit of stabilizing and possibly even a 15% rally in equities, but then it's likely to turn around. And part of that is likely to be a crude oil breakout to the upside if and when it happens.
I want to circle back to where you started in the beginning about some of the political maneuvers here. President Biden, he's thrown the kitchen sink at it. A record release from the Strategic Petroleum Reserve, allowing E15 gasoline sales this summer, outreach to the Saudis and Iran. What's been the impact? Is there anything the administration can do ultimately?
In the very short term, there's very little. This is the kind of thing that you have to plan for decades. I've been saying this on Yahoo and everywhere else that'll listen for the past 5 or 6 years. People think that with shale oil, you turn the spigots on when the price goes up, you turn the spigots off when the price goes down. And it's not only shale, it's everywhere else. It just doesn't work that way. To ramp up to production with higher costs, you need a reasonable expectation that costs are going to stay at profitable levels, which we don't have right now. And you need a reasonable expectation of that you're going to get ROI in that money, and we don't have that right now. And then it's a 6-8 month lead time. So there's just not much that can be done. You could possibly get a federal gas tax holiday. Individual states can do the same thing, but those are Band-Aids.
Backdrop is Exxon, Chevron, ConocoPhillips, all up 40% year to date. Bob Iaccino, great to see you, sir. Thank you.
We're taking a look at what's been happening with retailers. For that, let's bring in Mickey Chada, Moody's Investor Services Vice President. Mickey, thank you for joining us today. So as we've seen, Moody's lowered its outlook for the U.S. retail and apparel industry to negative on May 16th. Talk about what you're watching in terms of the business conditions and the risks.
Well, thanks for having me. So, as you know, retail up to last year was doing phenomenally well. The consumer was still strong. It was resilient. Retail sales are still looking positive. The reason we went negative is we're seeing a lot of pressure on the operating margins of retailers. As you saw from the reports of Walmart and Target the last couple of days, the consumer is feeling the pain of higher prices of food and energy. Gas prices are record high, food prices are up, and so disposable income is shrinking. And so the consumer is pushing back into what they're buying. So you've got these different events happening at the same time where retailers were taken by surprise and had inventory that they had bought to sell, looking at the robust consumer. And then things turned pretty quickly as inflationary pressures started to creep up and cost pressures. Retailers are feeling cost pressures on labor costs, their wages, input costs. And so their operating profits are definitely feeling the pressure. And so we went negative, and we're expecting the operating profits to decline for retail about 1 to 3% this year. And so a lot of the retailers are going to feel this in the next coming quarters.
And it's interesting because when you look at Walmart, obviously it's considered that bellwether of how US consumers are feeling. Earnings disappointed. We saw that Targets were even worse. But then you have Kohl's, which seems to be faring better. What's making some retailers more resilient than others right now?
Well, if you look at, Kohl's is a department store, and it is, about, I look at it as being a value-priced department store, a lot of private label product. It's off-mall. And there is another trend that is happening with consumers is that because of all the pandemic restrictions being removed, the trend from goods to services is also increasing. And that means that people are traveling more and they're replenishing some of their wardrobe as well as they get together with family, as they travel, and as they socialize more. And so we're seeing that play out as well. And so, certain retailers are probably going to weather the storm better than others. But Walmart and Target are very large retailers, and they have the capacity to withstand this pressure in the coming quarters. They're very good in inventory management, and they'll right-size their inventory based on consumer demand. So in the longer run, I think those retailers are stronger, they're bigger, they have the scale, they have a merchandise mix that resonates with the consumer. And Walmart, don't forget, is the largest food retailer in the country. And so, and that is an essential item that consumers need to buy. And so it's a non-discretionary item, and that drives traffic into a Walmart store. And we're seeing Walmart take share in food as its prices are better than the competition. And so that is a benefit that Walmart has.
And as you're mentioning, there's some brighter days ahead there, as you're mentioning, for some of these stalwarts, your Walmarts and your Targets. But you also identified 4 sectors that still have momentum left in the months ahead, but for different reasons: auto and auto parts, home improvement, value stores, and off-price. What are you watching in those spaces?
So when you look at auto and auto parts, autos have had record profits, and that's primarily because there's a shortage of cars. And so they've been pricing the cars at a higher price where the consumer has no choice. That if they want a car, there's a shortage of chips in that industry. And so the pricing and the profit per car that these retailers are generating is a lot higher than it has been. And so we think that that's going to continue, although at a lower pace. When we're looking at off-price, for example, that is a trade down for consumers. And off-price has always been very good in managing their inventory. If you go to a TJX or a Burlington, if you're in the store and you like something and you don't buy it then, there's no guarantee that the product will be there when you get back tomorrow or next week. So it's more of a treasure hunt kind of a purchase that resonates with consumers. They go in and they pick up something that is priced lower than the competition, and it might not be there. So those kinds of retailers are going to fare well.
Well, we will have to leave it there, unfortunately. I know we'll definitely have to have you back to break more of that down. Mickey Charter there, Moody's Investor Services Vice President.
If you're planning to take a vacation, get ready to pay even more. There's new data out from Hopper showing that the cost of hotel stays, they're up 36% from a year ago. Car rental rates surging 20% since the beginning of the year. So what's the best way to plan for a trip on a budget? We want to bring in Haley Berg, lead economist at Hopper. And Haley, when you take a look at the numbers, the demand is certainly there, but people who are traveling, they're going to have to pay even more here if they haven't planned their trip yet. So what do people need to know when they are planning to take a vacation over the next couple of months?
If you're planning to get out there and travel this summer, planning ahead is one of the best ways to get a great deal. Start monitoring prices early so that you'll be notified proactively when prices start to rise or if it's the right time to book. Really savvy travelers, though, are going to be super flexible. Flying midweek can save you $75 off of airfare for domestic travel, or checking in on a Saturday instead of a Friday can save you more than $75 on your nightly rate at a hotel.
Haley was surprised to see that the inflation, 18.6% on a domestic airline ticket, is not really the same when it comes to international travel. Why so the disparity, and how much can you save actually traveling internationally versus domestically?
International travel right now will only cost about 2.5% more than it did in 2019, compared to about 35% on domestic flights. And the reason for that is slower recovery on demand. We have seen a huge surge in demand for domestic travel and more regional travel to Mexico, Central America, but not so much of a surge to destinations in Europe and Asia. So international airfares on average have remained pretty much in line with 2019, given that slower return to demand.
Haley, you mentioned that surge in domestic travel. Where are people going?
Travelers are staying domestic, so domestic is still primarily where Americans are going, but they're headed to big cities like Las Vegas. Florida is an incredibly popular state this year. Beach destinations in Miami, Fort Lauderdale, Disney World in Orlando. So a lot of destinations for travelers who are looking to go on a leisure vacation, beaches, outdoors, in big cities.
Tell you what, I found that out trying to book a Disney trip. It was out of my league. Are there destinations domestically that you can fly in particular to save money? Maybe middle of the country locations?
Mm-hmm. The best way to get a deal is planning ahead, but there are some less expensive destinations. Think of smaller cities or cities that have multiple airports that might have lower prices. Boston's a great example. You can fly into Boston or into Providence, which has a few different low-cost carriers. So if you can be flexible on where you're going, do some research from your own airport, and you're likely to find some really great deals.
Haley, we've been talking so much about inflation. It's not just on airfare, for example. People are paying more and more when they go to the groceries, when they're filling up their car. I've read a couple of pieces of information in various travel sites saying that people are actually canceling their trips because of the higher costs that they are facing on a day-to-day basis. I'm curious if you at Hopper, if you guys are seeing this trend.
It's a hypothesis we've heard a few times, but so far in our data at Hopper, we have not seen any slowdown in demand for airfare, for hotels or rental cars. In fact, we did a survey of Americans just a few weeks ago, and more than 50% of them said that they expect and are planning to spend more than $1,000 on their summer travel this year, and about 27% plan to spend more than $2,000. So prices are higher, but it does seem like for now, consumers they've been stuck at home, they're ready to travel, and that pent-up demand is going to allow for these higher prices at least for a little while longer.
Can't help but wonder where demand and destruction comes in here. I'm on the Hopper app here. How does it differ from all those others on the marketplace?
Mm-hmm. You know, at Hopper, we have two key differences. One is that we are going to give you advice to help you save money. So if you're looking to book a flight, we're not just going to tell you the price. We're going to tell you you should wait for a lower price. We expect that price to be available on this date, and we'll notify you proactively. In addition to that, we've developed a suite of fintech products that help reduce price anxiety, risk, things like flight disruption protection that travelers can add to their bookings that enable them to rebook flights that are canceled for free, or if they miss a connection, we'll get them on the next flight without having to pay the difference. So fintech and using data to help make the traveler booking and traveling experience better it's our bread and butter, and it's what we do best.
Haley, the big driver here in the travel industry over the last 2 years has been COVID, and we're starting to see those headlines that cases are rising pretty significantly. We're seeing the highest number of cases that we've seen since November. Any idea how that's been impacting at least bookings over the last couple of weeks?
Mm-hmm. Typically, we see a slowdown in airfare bookings, at least during the month of April, in that section of time between spring break and summer travel booking. And at Hopper, what we've seen is that little bit of slowdown in April and then a resurgence in bookings in May. So we haven't yet seen anything unusual, but are expecting to see a really strong summer, continued travel.
All right, Haley Berg, Hopper's lead economist. Thanks so much for taking the time to talk to us.
The return to work is also bringing back work-related stress due to inflexible policies, according to Future Forum. Well, for more on this now, I'm joined by Brian Elliott, Future Forum executive leader and How the Future Works co-author. Welcome to the show. So first, I want to start by getting some of your key findings and surprises as you really talk to some of these companies and employees about the future of work.
Thanks, Rochelle. So what we do at Future Forum is we run a set of surveys and instruments and research on one side, and then we talk with executives in hundreds of companies on the other side. Future Forum Pulse is our quarterly survey of over 10,000 knowledge workers around the globe. And what we found over the course of the past 2 years is people's expectations have changed, and especially top talent expects that flexibility is a key part of their work going forward. In fact, flexibility is second only to compensation in people's consideration about where they want to be employed. And that's changing a lot about how people think about not only where, but when people work. There's all the conversation about how many days a week somebody can work from home. We're just starting to scratch the surface of an even more important issue, which is how do you allow for schedule flexibility? How do you get us away from that sort of fixed 9 to 5 where I can jam pack a day full of meetings and shove all the work into the evening? So there's just so much that's going on in terms of the ability to attract, retain, and engage talent that we wanted to put a book together around it with best practices from hundreds of companies around the globe.
And we did find in our Yahoo Finance poll the compensation and location or work from home flexibility also topped the list there. But so then if you're an employer hearing all these things that an employee wants in order to come and join your company, how do you adapt to that? What's the blueprint for that?
The starting point really is around not thinking about the policies that you're going to put forward, but what are your principles? So from an executive perspective, I did this with Slack's executive team. Slack is our sponsor here at Future Forum. Slack itself was very office-centric prior to the pandemic. Less than 3% of our entire employee base was remote. And so we had the same challenges that everybody else did coming back out of this, which is how are we going to think about how often people should come together? Instead of sitting there and saying top down, we're going to dictate what those rules look like, we realize the different teams have different needs. So let's start with principles. Like there are benefits to flexibility. So we're going to afford people the opportunity to work where and when it's best for them. But we're also going to provide them the tools. For example, team level agreements, ways that people can construct that a sales organization is going to normalize on a day or two a week in the office that's going to be their norm, or an engineering team that's going to come together once a month for a week for more immersive time together. So if you start off with a principle like flexibility matters to us and we're going to allow people to work where and when they're most effective, it's much easier than dictating those policies from the top down where you know you're going to get it wrong for the average.
And so if we're taking a step back, if you're the employee now and you're thinking of jobs, I mean, we saw that nearly 3/4 of workers who quit to take a new job ended up having feelings of surprise or regret in their new job, according to career coaching company The Muse. So before you even apply for a job, what should you be asking yourself so that you can try and find something that is a good fit for you?
So there's a couple of things that come to mind around that. Part of which is the grass is always greener on the other side when you join a new organization. So thinking ahead about what are you going to get out of it? Learning opportunities are really essential when we talk to people. Everyone's looking for flexibility. Can I work at least a few days a week from home to avoid the commute? And people are looking for career growth and learning opportunities so that they can continue to advance and grow. One of the things that we talk about in the book is the fact that organizations actually need to think about how do they help people develop and grow? How do you help people think about questions like not who's resigning, but do they say to you that they feel like they can grow and advance within that your own organization? So for a lot of teams, it's not necessarily about thinking about where you're going. It's about how am I going to retain the talented people that I've got today inside my four walls? Flexibility, learning and growth opportunities, and importantly, the third one, which is transparency. People who don't believe that their senior management is being open with them about their future work plans are 4 times more likely to tell us that they are definitely looking for new jobs. Trust, the ability to understand what's going on in the organization, is really key to retaining talent.
All right, thank you so much. Brian Elliott there, Future Forum Executive Leader and How the Future Works co-author. Thank you so much.